Private credit redemption wave hits 1.8T market as Apollo sells 3 by large fund. Two market signals dropped in the last 24 hours that point in the same direction. Bloomberg reported a fresh wave of investor redemption requests sweeping the $1.8 trillion private credit market. Hours later, Reuters confirmed that Apollo is in talks to offload a $3 billion private credit fund, citing a Wall Street Journal report. Taken together, these aren't isolated headlines. They're the same story told from two angles. The largest direct lending market in the world is being asked to return capital, and one of its biggest managers is looking for a buyer. For crypto-native investors, that matters more than it might appear. Private credit was the original poster child for tokenization, and the same week these signals arrived, tokenized real-world assets crossed $30 billion in total value. Two signals, same picture. The Bloomberg report describes a redemption wave hitting the private credit market as investors pull capital from funds that, by structure, were never built to give it back quickly. Private credit funds typically lock up capital for years and meter withdrawals through quarterly or semi-annual redemption windows with strict caps. The Apollo headline is the same dynamic seen from the manager side. Apollo is reportedly in talks to sell a $3 billion fund of private credit positions, which is the kind of secondary transaction managers consider when they need to crystallize value rather than wait for borrowers to repay. The Wall Street Journal first reported the discussions, and Reuters confirmed the broad strokes. Neither story alone is a market event. Both arriving on the same morning is a signal worth reading. Private credit's first real liquidity test. Private credit grew from roughly $400 billion in 2015 to $1.8 trillion today, with most of that growth coming after the regional banking stress of 2023 pushed mid-market lending out of bank balance sheets and into asset managers like Apollo, Blackstone, Ares, and KKR. The pitch to investors was higher yield than syndicated loans, less mark-to-market volatility, and direct relationships with borrowers. The trade-off was always liquidity. Private credit funds aren't traded. They mark their books based on internal valuations and external auditors, and they meter redemptions because the underlying loans cannot be sold quickly without a haircut. A redemption wave plus a $3 billion secondary sale at the same time tells you the gate is being tested. Investors are asking for cash. At least one major manager has decided it's cleaner to sell a portfolio than ride out the request through scheduled repayments. This is the first cycle in which private credit will be priced by the market, not by its own internal mark sheets. The price Apollo accepts for its $3 billion book will inform how every other manager values comparable positions, and that price discovery is precisely the thing the asset class was structured to avoid. The tokenized RWA parallel crypto's most pitched real-world asset narrative for the last 3 years has been tokenized private credit. Projects like Maple Finance, Centrifuge, Goldfinch, and Securitize all built infrastructure for putting private credit on-chain. Apollo itself runs ACRED, a tokenized version of its diversified credit fund, on the Provenance and Securitize rails. The pitch was that tokenization would improve the asset class in 3 concrete ways. Transparency, because on-chain books are auditable in real time. Liquidity, because tokens can theoretically trade on secondary venues without waiting for redemption windows. Efficiency, because settlement collapses from days to seconds. A redemption wave in the underlying market is the first real stress test of that thesis. If tokenized private credit holds up better than its TradFi parent, you have evidence for the structural argument. If it doesn't, the tokenization wrapper has limited value beyond cleaner reporting. The same week brought a related data point. Tokenized U.S. Treasuries on Ethereum hit a record $8 billion market cap, and the BNB chain tokenized treasury market crossed $3.5 billion. Capital is rotating into tokenized fixed income at a pace the data didn't anticipate 12 months ago. Whether some of that flow is investors looking for cleaner exits than TradFi private credit can offer is impossible to confirm from public data, but it is the right question to ask. Reading the next 2 quarters. 3 things will tell tokenized credit holders whether the on-chain version of the asset class delivers what the marketing said it would. The first is whether tokenized fund NAVs diverge from the underlying TradFi fund valuations. They shouldn't, but in a stressed market, they often will, and the spread will be informative. The second is whether secondary market liquidity for tokenized private credit improves as TradFi liquidity worsens. That is the structural argument for the asset class, and it will either hold or it won't. The third is how managers communicate. Tokenization promised more transparency. A redemption cycle is when investors find out whether on-chain disclosures actually mean better disclosure, or whether the chain just stores the same opaque numbers in a different format. For broader crypto markets, private credit stress is part of the same risk-off conversation that's keeping BTC at $88.44 and ETH at $2,333 as of May 11, 2026. The Fear and Greed Index sits at 50, neutral, which is consistent with a market that hasn't decided which way macro pressure resolves. Private credit cracks don't directly move crypto prices in the short term, but they do shape the institutional capital conversation that crypto has spent years trying to win.